Hey guys, welcome back to the channel. Montana here. In this episode, I'm going to be talking about technical analysis, chart patterns and structures. I'm going to specify on reversal structures. Now, I know on the last video, whenever I was talking about transactions and like what is happening behind the candlesticks, which is buy and sell orders, I I said I was going to talk about, rally-based rallies, drop-based drops, pockets of air and all that stuff. For that short of time, it's a pocket of air, which, again, I'm going to cover in the very next episode. This is all fascinating. Once you understand what order flow is, you see a candlestick chart and everything makes perfect sense. And then I realized that would be like an hour-long video. So I'm going to break it into 3 parts, which is why I'm going to talk about reversal patterns and reversal structures today. So pretty much there are 4 structures or four pieces of price action that govern all price movement. All right, there are others, but for the most part, there's essentially 4. There are continuation patterns or continuation structure. I can get it out today. Thank you. Which are rally-based rallies to the upside and drop-based drops to the downside. Then you have reversal patterns, which are drop-based rallies and then rally-based drops. Obviously, a drop-based rally is a reversal to the upside because it was falling before, and a rally-based drop is a reversal to the downside because it was rallying before it fell. Plain and simple. Yeah, you have pivots and all that good stuff, but for the most part, 9 times out of 10, all price action has some element of either rally-based rally or those 4 structures that I just mentioned. So let's dive into the characteristics of what reversal patterns look like. So first, I want to go over a drop-based rally. Here, if you have a hard time understanding what candlesticks are and how to read them, check out episode 1 or my first video. Tell you about the open, close, high, and low in the range of all candles. But here on this fall, this is an impulse move. Now, impulse moves, this is just a move to the downside, right? It's got nothing other than sellers hitting the bid, which is making price go down. And notice that all 3 candles, or essentially these 2, every candle closes outside or below the range of the prior candle. So this candle closes below the range of this one and making price go down. What you need to know about basing is what makes an area of basing is any time whenever you have like a leg candle or an impulse candle, which is either one of these 3. The most recent one, let's just say it's this one. This next candle would need to also close below it or outside of the range for it to not be basing. The fact that this green candle closed right here, it closed within the range of this last leg or impulse move candle. So did this one, so did this one. The open, don't worry about the open. It's where the close is. If the close of the candle closes within the range of the most recent leg or impulse candle, then you have basing. And then price rallies, so it reverses back to the upside. Rally-based drop is the exact same thing except inverse. Here you have 3 green candles that are all closing outside of the range, and if it's going up, it'd be above the range of the previous green candle. And then you have 3 candles. It can be 4, 5, 6, or 2, or 1 really, that closes within the range of this green candle, and then price falls. Now, small exception is this doesn't happen that often, but it does happen. Even if the candle sometimes doesn't close within the range of the previous leg candle, but it closes at a neutral, like this one. Again, check out my first video on what a neutral candle is. It closes halfway in the body. That's a neutral candle. Then that's also basing. So here you have rally-based drop. Now this is a perfect example. This is a poster example of that'll help you understand how this ties into what I was saying last episode with transactions. And it kind of helps with speed as well. Anytime that you have a balance of supply and demand, or essentially a balance of buy and sell orders, which is what transactions are, that's just going sideways. So when price is falling, that's obviously an imbalance, but that's just a move to the downside. What you need to know about price action whenever it's moving is you have current market price, and then you have the sellers that are above current market price, obviously, because the sellers obviously want to sell high, and the buyers below current market price. The sellers they have an asking price, and the buyers, they have a bidding price. If price is falling, what a transaction or what order flow is, and we covered this last video, is order flow is the pairing of a buy and sell order. But depending on what the direction is, if it's order flow to the upside, you're gonna have buyers hitting the ask, making price go up. It's a buy and sell order that is paired. Obviously, if you want to buy something, you need a seller. But if you hit if that pairing hit the asking price, then price is going up. If that pairing hits the bid price, then price is going down. That's all movement is, and that's what order flow is. So as price is going down, you have the sellers hitting the bidding price, which forces price to go down. Then you have balance of price. Now, this is what moves markets, and what moves markets is supply and demand. If you need an imbalance of price to, let's just say, to the upside, so you need demand, you by definition needed to have had a balance of price to get an imbalance of price. 9 times out of 10, I've realized that you can have pivots that just go up and just go down. I've realized that. But for the most part, if you have an imbalance of price, and that means price needed to have a balance to begin with. Hence our drop-base rallies, which is our reversal structures. And notice that reversal structures, drop-base rallies and rally-base drops, have something in common with continuation patterns, which are rally-base rallies and drop-base drops. They all 4 of them have the word base in them. That exists for a reason. Check this out. Here, price is just moving. Then you have an equilibrium of supply and demand, an equilibrium of buy and sell orders. Whenever it's going sideways, price is just going like the bid, the ask, the bid, the ask, the bid, the ask. In really simple terms, it's just doing that. It's just going sideways. So you have a balance of buy and sell orders. It's not going anywhere. And then you have a strong move to the upside. The only way the price can move ballistically up is with a lot of demand. So there's an imbalance of more demand than supply, giving you the reversal to the upside. Also giving you a good area in the future, which I'm going to cover in a few minutes, where if price re-enters, you know that there's overwhelming demand there. You have empirical evidence that thanks to the footprint of price action, it tells you, hey, there's demand here because it was balanced. And then there was a massive imbalance because, well, it moved to the upside. And Economics 101 says more demand than supply, price goes up. And inversely, same is true, which let's go over this right now. To the upside, price is rallying, which means you have buyers hitting the ask on the way up. A buy and sell order that is paired, but is paired at the asking price, making price go up. Then price goes sideways. You have the bid, ask, bid, ask, bid, ask, just making it go nowhere, really, sideways. And then a large move to the downside. The only thing that can make price move quickly, speed. Speed is volatility, and volatility is an imbalance of supply and demand. I said that in a previous video. We talked about this last episode, that volatility is speed, and speed occurs where? In areas of imbalance. The only thing that can do that is an overwhelming amount of supply. And the fact that you had a balance of price and an imbalance of price, well, the only way you get an imbalance is if you have a balance, and if you had a balance and it moved down, that means overwhelming supply had to come into the market. And it did. It fell. Thus reversing your move up, now going down, and telling you empirically, hey, there is overwhelming supply here. Obviously, it's not a perfect world, and price isn't going to move from either an amazing or not so amazing supply and demand zone every single time. But the odds of price moving away from any area of demand or supply is increased if you choose an area that is strong enough. And the way you see that is by having an area that has an imbalance. That's all a reversal structure is, or a drop-based rally and a rally-based drop is price is falling, then you have a balance, then imbalance in the opposite direction. Plain and simple. And that is what gives you supply and demand zones. And notice how I say, or why I say supply and demand instead of support and resistance. And I know support and resistance is so popular, particularly on YouTube, and I don't understand why. Support and resistance, it's an ambiguous term. It just means, oh, there's something ethereal there that is stopping price, or there's something ethereal there that is holding price. There is no meaning to it. There is no why. you can't just, oh, it's support. Well, why is there support? If you use the word supply and demand, it makes all the difference in the world. It's nuanced, but it changes the game completely. Everyone knows, and this is, I mean, tried and true, time-tested fact that more supply than demand, price falls, and more demand and supply, price rallies. It gives you confidence to go into any kind of position. It gives you confidence to understand that this is why price is doing what it's doing. And the very fact that people are buying and selling, and the only way you can buy and sell is with a buy order and a sell order. Well, more people buy, they do that out of greed, which is demand, making price rally, and the same to the downside. So just understanding and using the right terms makes all the difference in the world. So let's see what this looks like on a real chart. All right, GameStop, which is what I explained yesterday in terms of, or not yesterday, but on last video in terms of order flow, how you had ballistic movement up and how it was a pocket of air. I'm just going to give you a small taste of what the, not next episode, but the one after that, which is pockets of air, and how this ties in so beautifully is this example, because this was a beautiful case study of order flow. The very fact that you have, and the examples that we had on rally base drop and drop base rallies, the fact that you need time for that basing to take place. You needed those 2, 3, 4, 5, whatever, how many candles of basing for there to be a balance. What happens if there is no time for that to happen? Then you just get ballistic movement up. Nothing ever has that rate of growth, whether it's a supernova explosion. The faster and hotter it is, the faster and hotter it dies. Populations, if they go up like a hockey stick, it comes down the exact same way, because math. This is the exact same reason. Notice, whenever GameStop rallied from, let's just say $50 all the way to $450, it had almost a 100% retracement. Why? Because there is no continuation pattern. There's nothing. There's no balance, then imbalance to prop it up. It's just one solid go. The amateurs got in on the first go. And just to give you another piece of candy, so to speak, you see this continuation pattern, rally, base, rally. Amateurs and the rookies got in on this leg on the first one. No, that's not what you do. You wait for price to come back down into demand. And this is the leg that you should have caught. That is the leg that professionals get. And if you're watching these videos, these are the legs you're going to be catching. Not the first go. What's your target? Where's your entry? You have nothing. You're just going on blind faith that, a whole bunch of people just got into a trade. Okay, great, awesome. Just stay away from that stuff. Amateurs do that. Here's what the professionals do. Rally, base, rally. You had basing, balance of demand, and then an imbalance of demand. Massive imbalance of demand. Well, what happens whenever price re-enters an area of overwhelming demand? It bounces back up. It's a mechanical function. Price has no choice. It is emotional to a degree, but the only way you execute that emotion is with a mechanical buy or a mechanical sell. And if you have an overwhelming amount, let's just say here, an overwhelming amount of demand, like let's just say like 50, I'm going to throw out a number here, $50 billion worth of buy orders, and coming down, you only have about $10,000 worth of sell orders. It's math. It's just math. It wins. You get a rally. So that's a small tidbit as to what we're going to go into continuation patterns on the next video. So back to drop-based drops and rally-based drops. I'm sorry, drop-based rallies and rally-based drops. What they do is obviously a reversal pattern. What they are is a reversal pattern. And obviously they eliminate opposing trends. Actually, here you have a rally-based drop, right? And in a continuation pattern, which again, we're going to cover, drop, base, drop. Why? Because here you have an impulse move, and then here's the low. So that's the range. This candle closed within the range of this candle, giving you a drop, base, drop. No coincidence that this rally, base, drop happened right here. But I'm jumping ahead. Here you have a downtrend, and you have a drop, base. Why? Because this last candle, this impulse move candle, you needed to, in order for price to continue to fall, you needed this next candle to close below the low of this one. It didn't. So then you have a very clear basing and ballistic movement out. There's empirical evidence that demand exists there, period. And then rallied, breaking that downtrend. So it's a reversal, and like all reversals, they break the opposing trend, plain and simple. Then price rallied and giving you these nice 3 candles that are closing above the range of each of the previous one until you get to this one that also is a neutral candle. Check out episode. Why do I keep on saying episode? Video. Check out my first video. It's a neutral candle. It's pretty neutral, and it closed within the range of this candle here. And just odds enhancers, it closed in this base drop supply zone, which would have given you something like like that if that were red really quickly there, and it happened there. So just odds enhancer. Wouldn't it be nice if you had, from September to November, so 2 months, knowing where price is going to bounce off of? That is what order flow gives you. If you have an imbalance of supply and demand, and to have an imbalance, you need a balance, so basing, and then ballistic movement up, or in this case, basing and ballistic movement down, that broke this uptrend, by the way, then empirically demand, supply. So after price rallies and after it falls, you then have clear evidence that this is where price is going to bounce from to the upside. And then when it enters an area of overwhelming supply, this is where it's going to fall from as well. And this move here, this is the one I really like, but that we'll get into, and that's another story for another time. Oh man, you just want to go off into the weeds, but you can't. You got to take it so steady. If not, you end up talking for hours and hours. So what I said on my speed versus volume episode is reversal candles and reversal patterns are fantastic to get, but if you choose the right zones, you end up getting them anyway, right? For example, doji, indecision, and then fall, and then you have dark cloud cover, and all these other bullish engulfing, definitely all happen in areas. If you choose the right ones, you will get them as a matter of course. Now, I also said that if you choose an area of overwhelming demand, because you get those reversal candles, which obviously are in layman's terms a representation of volatility, because volatility is a lot of supply and demand, which is where price moves from to begin with. You will almost always, not 100% of the time, but almost always see, for example, drop base rallies in an area of demand. Notice here you have drop. This is the low. So this is the impulse move candle. This is the low. You see this candle right here, it closed within the range of the previous one, and then strong rally. Well, no coincidence that's where you get, since there is demand here, it made price rally, and then this structure gave you another zone which made this price rally. But we're getting off into the minutia. But for the most part, you'll get, just like those reversal patterns or those candlestick patterns happen in very strong areas. For the same thing happens for reversal patterns, because if there's an overwhelming amount of supply and demand, price will reverse in those areas. Like I said, in this drop base drop here, I know it's green, but just ignore that for a second. You get your reversal pattern to the downside. Those are where most often you're going to get your reversal patterns, and those areas will then consequently be their own areas of supply and demand, just like you see here. That's all that moves markets. And the fact that if you train your eye to, one, identify them, and train yourself to understand that it's not support and resistance, that doesn't give you any meaning as to the answer or question of why price does what it does, you're going to have a much harder time understanding how this works. So what happens in basing and then reversal that makes price bounce from that area whenever it re-enters? This is what happens inside, and it's fascinating. This is a brilliant example. I have learned so much from this uptrend. I have done so many studies on just this price action alone, particularly this basing. If you understand what basing is, then trends are easy. You get basing down, everything else is lemon pie. It's great. So here you have a drop base rally, very clear, kind of like you have a, prices going down and then clear reversal. No coincidence that it happens in a demand zone, right? Losing sight of my camera here, in a demand zone, and then rallies. Now, this bump here, why did that happen? Here's why. This is what happens within a basing. Now, this whole chart is a daily chart, right? So let's find out what happens when we go into, in fact, I'll even hold this up here. So let's find out what happens within basing. So this is the drop base rally that we see on a daily chart where every candlestick is 1 day. And I know I haven't explained what time frames are, but I promise I'm getting there. I'm just trying to figure out how to feed an elephant in any kind of reasonable and efficient time frame. This is a 240 chart, which 240 minutes is 4 hours. Every candle represents a 4-hour time period. Here you have your drop base rally. This is what I mean by you have a balance of supply and demand, a balance of buy and sell orders. Here's a drop base drop continuation pattern we're gonna be talking about in the very next video. And here, so a drop base rally. And we're talking about this one, drop base rally. What do you know? It's bouncing from that area. I wonder why. There's an equilibrium. It's bouncing here for the better part of, what, 2 weeks-ish? 2 weeks, just bouncing back and forth. There's a balance. Until all of a sudden, rally, base, rally. Empirical evidence that there is demand here. There is the origin of all large moves is where the imbalance of, if in this case to the upside, is where demand exists. Period. What moves price? Demand, buy orders, mechanical function, emotion or not. It takes gasoline to move. That's where the gasoline is. This demand zone is what broke above the sell orders. Basing where there's equilibrium, right? And I know I'll bring this back up now. I know I explained how you have price falling and then you have buy, sell, or like hit the bid, the ask. And that's just a positive representation. But on a real chart, there's a bit more of a fluid movement to it. That's what you see on this chart. Let me go back to it. That's what you see on here. There's a balance, right? It's basing, it's just going sideways. It's going up and down, but the price curve is pretty tight compared to, I know you don't know what a price curve is, but compared to the whole thing, that's pretty tight. And then you have a massive imbalance of price. Wham. Not only is this a continuation pattern, and if you have a rally-based rally, it's going to continue, which we'll be covering. This is why you get this beautiful leg on this daily chart. I forgot to change my cursor over so you can see. This bounce, I'm gonna let you guess where that happened. Right here. That's demand, and that gave you that bounce. No coincidence. This is the area where overwhelming amount of buy orders came in that broke above all these sell orders that were holding price down. There's an imbalance of demand there. To give you another example of why you got this massive go, just how you had basing here, you had basing here. This is where your basing, your long-term basing is. The leg that broke it right here. You come back into an area where there is overwhelming demand. Math, physics, mechanical function. So that's what structures are. This was a small insight as to how supply and demand works, but you need an understanding on how this linked to my last video, which is transactions, which are buy and sell orders and how they work. If you have an area where a lot of people put in buy orders, price moves ballistically away from there, that's a footprint. I mean, that's just your fingerprints are all over that crime or large coupon for a large or for a pretty big opportunity on how to grow your account. Let's just put it that way. And it also ties into just understanding the DNA of price. And once you understand what price action is, then everything kind of ties into itself. So this is what supply and demand is from the very beginning, but we're going to go over structures, reversal structures now, and how they reverse price, how you have equilibrium and then an imbalance, both to the upside and downside. I know we covered, price going up, but it's already been 30 minutes, so I'm going to stop now. But the same is true to the downside. And the reason why that basing holds next time price re-enters is the area within that basing on a smaller time frame that breaks it. There are unfulfilled buy orders there. That's where the demand and supply game comes in, which we will be getting into. So I look forward to it. I hope you enjoyed it. Very next episode. Why do I keep on saying episode? Just say video. This bothers me. Next video, I'm going to go over continuation patterns, which is drop-based drops and rally-based rallies, and why they tend to always exist on certain or in certain areas. Look forward to the next one, guys.